Welcome to the CFO Strategy Brief series. In our last episode, we explored the difference between reinvention champions, those organisations that renew, regenerate continually with an outcome of continual value creation, versus one-hit wonders, those who are only able to change once but not repeat that act, thereby risking a strategic drift and episodes of value destruction. In that process, we emphasise the Strategic Management Institute's, or SMI's, cycle of organisational transformation and renewal, a process of reframe, restructure, revitalise and regenerate, as a tool that distinguishes hollow restructuring from genuine transformation. Today, we shift the lens from economic design to governance design, from management capability to board oversight. The question changes from what do we want to become to what strategic risks are we not able to see and why. This episode examines when strategy blindness becomes a governance failure, what causes it across global markets, and what CFOs can do about it. My name is Paul Hunter. Thank you for joining me. I hope you enjoy our conversation. For decades, strategy has been treated as too speculative to govern. The future, boards are told, is unobservable, untestable, and therefore beyond the reach of normal accountability frameworks. Boards govern capital allocation. They govern financial risk. They govern compliance and audit. But strategy itself? That was left to management, the black box where assumptions were made, commitments were set, and billions were deployed, all with minimal board visibility into how these decisions were formed, whether the assumptions were tested, and when they should be challenged or renewed. The result is a governance gap, one that has become increasingly dangerous. Boards approve restructurings, capital allocations, and major acquisitions. They hear presentations. They ask a few questions, and then they vote. But they rarely govern the capability to regenerate, the organisation's capacity to sense, reframe, and renew its strategy on an ongoing basis. When restructuring repeats every few years, when innovation portfolios are vulnerable to quarterly earnings pressure, when the same strategic blind spots keep recurring, that is no longer just a management weakness, it's a governance failure. So how widespread is this problem? Well, recent research examining 30 Fortune 500 companies across a broad range of industries reveals a striking pattern. Approximately 85% follow the same predictable annual program. Q4 planning initiation in October-November. Strategic communications concentrated in January-February during the Q4 earnings calls. And then strategic ratification at April-June when all the annual general meetings are conducted. More striking still, though, is the research found that 0 Fortune 500 companies have operationalised continuous strategic intelligence systems. Every major corporation says strategy should be always on. Microsoft CEO Satya Nadella articulates it perfectly. Thinking in decades, but executing in quarters, he suggests. Yet not a single company demonstrated governance mechanisms that make strategy truly continuous. Strategic updates still occur through quarterly earnings calls every 90 days. Annual investor days, once per year or every 2 to 4 years. Annual shareholder meetings and ad hoc announcements when material events force disclosure. This pattern, though, isn't confined to the United States. Recent analysis of Australia's ASX 50 companies, representing over $2 trillion in combined market capitalisation, reveals a strikingly similar dynamic. Approximately 95% have no systematic green shoots portfolio governance. McKinsey found in 2021 that only 25% of ASX 100 companies had an executive with transformation portfolio responsibility, a capability critical for sustained reinvention. 5 years later, in 2026, that figure appears unchanged. This isn't abstract theory, though. Let me give you a concrete example that illustrates exactly what this governance gap looks like in practice. We're going to look at Ford, the automotive company. In December 2024, Ford announced a $19.5 billion write-down on its EV strategy. $8.5 billion in asset write-downs, $6 billion in battery joint venture dissolution, and $5 billion in program costs. CEO Jim Farley's explanation was candid. When the market really changed in recent months, that was the main trigger. But here's the governance question. Ford's board did everything right. They approved the EV transformation strategy, they monitored quarterly progress religiously and received regular updates through formal governance channels. Ford met all its disclosure obligations. It filed 10Ks on time, it held annual meetings, it had audit committees and strategic reviews. What the board didn't govern was whether the underlying assumptions were being continuously tested and updated as market conditions evolved. What questions could they have been asking? Some examples. What are the consumer trends in adoption rates? Will the charging infrastructure keep pace with us, with the consumers? What are the regulatory timelines? What the board did was approve a destination and then monitored execution. What it didn't do was govern the ongoing interrogation of whether the destination itself remained valid. By the time Jim Farley became conscious of the apparent shift in the market demand, billions were already committed. Capabilities had been partially built, supply chains had been restructured. The write-down, when it came, was not a strategic insight, it was a reckoning. And the board had been blind to the drift, not because governance systems didn't exist, but because those systems were designed to monitor outcomes, not to govern the formation and continuous renewal of strategy, the way you do it, the way you implement it, and the content itself. This is the governance gap in action, and it's not unique to Ford. Traditionally, directors enjoyed a measure of legal protection known as safe harbour. The principle was straightforward. Directors would not be held liable for strategy that later proved unsuccessful, provided they acted in good faith, were reasonably informed, and exercised care. The underlying assumption was simple. The future cannot reasonably be known. If you made your decisions based on the best available information and process at the time, courts would defer to your judgment under the business judgment rule. It protects against hindsight bias and encourages risk-taking, which is essential for growth and innovation. But it also created a blind spot because the future was considered unpredictable. Many boards stopped asking whether the organisation had the systems and capabilities to test assumptions, explore scenarios, and renew strategy as conditions changed. What the research reveals is more fundamental. Boards aren't just culturally inclined toward annual cycles, they're legally constrained by them. How do I know that? Analysis of Fortune 500 disclosure frameworks demonstrates that approximately 92 to 95% of strategy cycling time is explained by regulatory compliance calendars rather than management discretion. To prove the point, there are 5 overlapping legal regimes that can be identified that create an inescapable annual rhythm. They include SEC Form 10K deadlines, MDA and A requirements under Regulation SK Item 303, material change disclosures, Delaware corporate law specifically, and of course the Sarbanes-Oxley Act. The convergence of these 5 regimes creates what appears to be an annual ritual, but is actually a legally mandated disclosure framework. Q4 earnings season begins around January 15 and runs through the end of February, not because management prefers it, but because 60-day Form 10K deadlines make that timing structurally inevitable. Australian corporations face parallel constraints. ASX listed Rule 3.1 requires immediate disclosure of information that a reasonable person would expect to have a material effect on, price or value. Annual reports must be lodged within 3 months of a financial year end, and on it goes. The ASX corporate governance principle goes even further. It requires boards to oversee the company's processes for making timely and balanced disclosure, and to have formal policies and procedures. Yet, like their US counterparts, ASX 50 companies demonstrate the same governance gap. Boards govern disclosure compliance diligently, but rarely govern the continuous formation and renewal of strategy. Now here's the crucial insight. Legal requirements dictate when strategy must be communicated to markets, but they do not prohibit continuous strategic intelligence internally. The regulatory framework mandates disclosure windows. It does not mandate that boards remain blind between those windows. This is where the governance expectation is evolving. Safe harbour still protects directors who act in good faith with reasonable information. But reasonable information now includes whether the board has governance mechanisms in place to oversee strategy formation and renewal, not just strategy outcomes. Today, boards have access to augmented visibility, real-time dashboards, AI-powered scenario planning, strategic intelligence platforms that can model multiple futures, stress test assumptions, and track whether the organisation is building regenerative capacity or eroding it. The legal question is shifting. Did the board ask for scenario work before approving irreversible capital commitments? Did it govern the balance between sustaining the core and seeding the future? Did it ensure that strategic assumptions were tested and updated as conditions changed, not just at annual intervals, but continuously? The regulatory disclosure calendar is fixed. Quality of the governance between those checkpoints is not. And that is where fiduciary duty is expanding. Both the United States and Australia, where governance oversight of strategy was present, but not sufficient. These are not cases of fraud or bad faith. They are cases where boards governed capital and compliance diligently, yet failed to govern the coherence, assumptions, and regeneration capacity of the strategy itself. Case under consideration is the Boeing 737 MAX. This case demonstrates what happens when speed and cost dominate strategic logic without board visibility into underlying assumptions. The board had no standing committee responsible for overseeing aeroplane safety. Board meeting agendas focused on restoring profits and efficiency. Management's periodic reports did not include safety information related to product design, and the board had no mechanism for receiving internal complaints or whistleblower warnings. But the governance issue ran deeper. The strategic choice to reuse the legacy 737 airframe, rather than design a new aircraft, was driven by time to market and cost considerations, motivated by competition with Airbus. That is a valid strategic trade-off, no doubt about it. The question is, though, did the board have the visibility and the governance mechanisms to challenge that logic? To ask, if we are competing on speed and capital efficiency, what assumptions are we making about engineering risk, pilot training requirements, and regulatory approval? What happens if those assumptions prove wrong? Boeing ultimately failed 33 of 89 FAA product audits, a 37% failure rate. Yet the board was not asking the strategic risk questions that would have made the trade-offs visible, debatable, and governable. Another case is General Electric, better known as GE, and it's about addressing what happens when the board defers to management on enterprise coherence. As you will probably be aware, GE suffered a long period of decline under CEO Jeff Immelt. It remains one of the most studied governance failures, in fact. $449 billion in shareholder value lost. A board widely criticised for deferring too much to successive CEOs, failing to challenge the coherence of enterprise strategy. Major acquisitions, such as the $23 billion write-off on Alstom, approved with poor due diligence and significant reverse hostage concessions that changed key assumptions. What was missing? A systematic process for identifying and challenging strategic assumptions. A devil's advocate mechanism. Clarity on what success and failure would look like, with defined milestones and decision triggers. GE's board was competent, experienced, and engaged, but it did not govern the formation and renewal of strategy as a discipline. Let's be clear, however, the Australian market shows the same pattern, and undoubtedly the FTSE 100 in the UK, as many other stock exchanges will also. But coming back to the ASX, our recent analysis shows that over Australian $2 trillion in combined market capitalisation found that most boards govern restructurings, capital allocation and compliance rigorously, but have no systematic way to see or govern a portfolio of future bets. A handful of companies, such as Commonwealth Bank, BHP and Wesfarmers, three of the largest on the ASX, have executed major digital portfolio or platform moves. Yet even they lack a governed, always-on view of emerging growth options and the assumptions that lie behind them. Majorities sit in steady state, operationally sound, meeting disclosure obligations, but treating transformation as an occasional event rather than a continuous governance responsibility. In the broader context, episodic transformation is apparent across all markets. These aren't isolated incidents. Similarly, United Health underwent a management overhaul with the CEO's return to rebuild investor confidence. He instigated a one-time intervention rather than continuous governance of regeneration capacity. Overall, our findings validate that one-hit wonder risk is not company-specific, not US-specific, not industry-specific. It's systematic, a global corporate governance blind spot created by the convergence of annual planning cycles, legally mandated disclosure windows, and the absence of continuous strategic intelligence. This is where the CFO becomes not just a nice-to-have or friendly advisor, but an essential steward of the organisation. He doesn't act as a barrier, but as a necessary creator of friction. In episode 1, we positioned the CFO as the architect of the organisation's future being. We asked, what do we want this company to become? In this episode, the CFO takes on the second, complementary role, enabling the board to govern how that answer is made, tested and renewed, not just at annual intervals, but continuously. And it's because CFOs are uniquely positioned to do this, and that's for three reasons. First, as question holder. Here, the CFO can bring forward the uncomfortable strategy risk questions earlier, before capital is committed and options are foreclosed. Questions like, where are we making big, untested assumptions? What happens if consumer adoption is half what we've modelled? What if the regulatory environment shifts? And what if our largest customer churns while we're mid-transformation? These are not finance questions, they are strategic questions that require financial discipline to surface and scenario analysis to answer. When Commonwealth Bank commits Australian dollar $2.3 billion annually to technology and AI, what scenarios stress test the assumption that digital-first banking will defend margins against neobanks and embedded finance? When BHP pivots to copper from electrification, what scenarios model demand if the energy transition proceeds slower than base case, or if substitution technologies emerge? Second, an assumption challenger. CFOs can insist on scenario work, not just base case economics for large irreversible decisions. When management presents a business case with a single set of projections, the CFO's job is to ask, what's the downside case? What's the stress case? At what point do the economics no longer work? And what will we do then? This is not pessimism, it is governance discipline. It forces the organisation to define both success and failure upfront, rather than waiting until sunk costs cloud judgment. Leading practice in CFO strategic risk governance demonstrates this role. CFOs should frame discussions about major risks as crisis scenarios requiring contingency planning, lead corporate-level discussions of risk preference, use risk analysis to inform investment decisions, and stress test business portfolios against integrated scenarios. Boards now expect sophisticated risk models integrating financial, operational, and reputational factors, and CFOs are positioned to deliver them. When Fortescue Metals pivoted to green hydrogen, did the board see scenarios that modelled technology cost curves not declining as fast as hoped, or capital markets becoming less patient with long-dated bets? If those scenarios had been available to Macquarie Bank's board, the $5 per share erosion the bank's CFO now warns could happen could have been anticipated and governed much better, not discovered retrospectively. Third, as a visibility enabler, the CFO sponsors the strategic intelligence capability that lets the board see regeneration capacity, not just last quarter's numbers. This means building or acquiring the systems, dashboards, analytics, governance platforms that make the cycle of transformation and renewal visible. whether the organisation is reframing proactively or reactively, whether capital is flowing towards stabilisation or design disruption, whether the green shoots portfolio is expanding or contracting, and whether the assumptions underpinning major bets are still valid or have quietly changed dramatically. This is not about the CFO becoming the strategist. It is about the CFO reframing friction as value protective for both management and the board. The board needs these questions asked in order to fulfil its oversight responsibilities. Management too needs these questions asked in order to test and strengthen its own strategic logic. And the organisation needs these questions asked in order to avoid the gale of value destruction that comes from untested assumptions scaled at speed. Again, it's not all bad, because not all boards are blind between checkpoints. When BHP walked away from the $49 billion Anglo-American bid in 2024, the decision reflected disciplined scenario analysis. The board had visibility into integration risks, copper price sensitivities, and capital allocation trade-offs. The no was as strategic as any yes. This kind of discipline distinguishes regeneration champions from one-hit wonders. But this governance precision is rare, and even BHP's regeneration governance remains implicit rather than systematic. The contrast with how Ford's board governed its EV transformation is instructive. Ford monitored quarterly progress meticulously, but didn't govern the continuous assumption testing that would have surfaced the $19.5 billion write-down before billions were committed. BHP said no to a transformation acquisition because it had visibility into the assumptions underlying the bid. Ford couldn't stay course correct on its transformation. It lacked that same continuous assumption governance. So this is the CFO's leverage point, not rejecting transformation, but insisting that transformation bets come with scenario analysis, assumption tracking, and decision triggers visible to them and the board. What next? Well, the opportunity is to treat strategic intelligence as governance infrastructure along with critical information for strategic decision-making going forward as well as looking back. As a governance infrastructure, it sits alongside risk management systems, treasury platforms, and performance reporting tools. Strategic intelligence does not replace the legally mandated checkpoints we explored earlier. It makes them easier to meet by giving boards continuous visibility between them. A good system, too, will allow you to make separate reports from that system, thereby negating the need to treat it as an independent program. In practice, this means three things. First, making strategy governable between mandatory disclosure windows, showing where the organisation is in its strategy journey, how capital is flowing by intent, sustaining the core, strengthening capabilities, or seeding disruption, and how the assumptions behind major bets are evolving as conditions change. Second, maintaining a visible portfolio of green shoots and adjacencies with clear signals for expansion, scaling, pruning, and learning, dare I say unlearning, rather than leaving future options buried in business unit narratives. Third, tracking the assumptions that underpin large commitments, market adoption, technology costs, regulatory timetables, competitive response, and reviewing them with the same discipline boards apply to covenant compliance or liquidity stress tests. For CFOs, the most pragmatic way to position this is compliance first, strategic advantage second. The same continuous visibility that lets boards govern strategic assumptions and regeneration capacity also reduces the risk of regulator queries, simplifies complex or annual report preparation, and strengthens evidence that directors act on reasonable information about strategic risks between formal reporting dates. Once that foundation is in place, the payoff extends to faster scenario work, early detection of assumption drift, and better protection of innovation portfolios from short-term earnings pressure. There are now tools that sit inside existing analytics stacks and keep these regeneration questions live in front of finance and the board. A Power BI-based strategic intelligence platform is one example of this category, something that can plug into data the CFO already trusts and render strategy, capital allocation by intent, green shoot portfolios, and assumption tracking as part of the normal governance pack. But the point is not any specific product, it is the governance discipline that continuous visibility enables. This brings us to one concrete action before your next major transformation. Commission a regeneration governance assessment. This is not a strategy review. It's not a performance audit. It's a focused assessment that asks, do we as board and the finance leadership team have the visibility and processes to govern strategy formation, not just outcomes? Do we govern how strategic assumptions are tested, how scenarios are explored, and how the organisation senses and responds to change between earnings seasons and the AGMs? Do we have mechanisms to govern the balance between sustaining, strengthening and disrupting, and to protect innovation portfolios from short-term pressure? Can we see at any point whether regenerative capacity is building or eroding, or are we still governing only cost, capital and compliance, leaving strategy as a black box we approve but do not truly oversee? The Fortune 500 and ASX 50 research validates the need, as it would, I'm sure, for many other corporations from all around the world. Most companies are locked into an annual rhythm, and none have operationalised continuous strategic intelligence, despite declaring that they want to. They want to think in decades and execute in quarters. The gap between what boards say they need and what they actually govern is complete, which means the first movers who close it operationally, not just rhetorically, will gain significant strategic and reputational advantage, something the analysts love. To conclude, restructuring is not optional, capital discipline is not negotiable, and regulatory deadlines are fixed. But if finance only sponsors blunt cost programs and boards only see strategy at annual intervals, value destruction is amplified and the organisation becomes leaner but more fragile. If instead finance insists on clarity about what we are becoming, on reframing before restructuring, and on governed program of renewal between disclosure windows, the same energy converts into creative disruption and regeneration. As CFO, you do not just fund the journey, you shape the questions, enable the governance, and increasingly architect the systems that make strategy governable every day, not just at results season. Let's then, to conclude, look at 3 practical takeaways. 1. In your next board strategy discussion, ask not just, do we approve this plan, but do we have visibility into the assumptions behind it, the scenarios that stress test those assumptions, and the mechanisms to update them continuously. 2. Sponsor a regeneration governance assessment to test whether the board can govern strategy formation, testing and renewal between quarterly and annual checkpoints, or only retrospective financial outcomes. 3. Build or acquire strategic intelligence capability that makes capital allocation by intent, green shoot portfolios and assumption tracking visible to the board, treating it as governance infrastructure that supports both compliance and strategic excellence. Strategy is not a document presented once a year. It's a living system. When regeneration becomes a governed rhythm rather than a one-off event, value creation becomes continual, not episodic. The globally listed corporations' patterns show the challenge is universal and the gap is complete. The question is, which CFOs will architect the systems that make continuous governance possible, and which organisations will move first? In Australia, where markets are concentrated and networks are tight, the first CFO who can show investors a governed green shoot portfolio, auditable assumptions, and capital aligned with strategic intent will not be explaining last quarter's variance. They will be visibly architecting the company's future, its being and its capacity to renew. Thanks for listening. This has been the CFO Strategy Brief. My name is Paul Hunter.